Hello and welcome to the Of Interest podcast. I'm Gareth Vaughan from interest.co.nz. New Zealand banks really love housing. They do the majority of their lending to people buying property. For example, ANZ, the country's biggest bank, has $104 billion of housing lending, which is 71% of its total lending. And it's a similar story at the other major banks. 69% of ASB's total lending is housing lending, as is 66% of Westpac's, 55% of BNZ's and 84% of Kiwibank's. So why do banks love housing so much? Is this good for the overall economy? And if not, what, if anything, could be done to change things? To discuss this, I'm joined by Martien Lubberink, Associate Professor at Victoria University's School of Accounting and Commercial Law. Martien has previously worked for the Dutch Central Bank and contributed to the development of bank regulatory capital and disclosure standards both in Europe and globally. Hi Martien, and welcome to the Of Interest podcast. It's great to have you with us. Just to get us underway on this, can you explain why banks do love housing so much?
Yeah, I can explain that. I think an important reason is that we love housing as well as a nation. So it's more, the politics are very important here. In many cases, you can see in many countries, you can see that the importance of politics tends to affect the way the financial system is set up. And in New Zealand, we love houses, and the entire political system and financial system is set up in such a way that it promotes the ownerships of houses. And so the bank regulations and other regulations are there to sort of promote that as well. And that's probably one of the reasons that we observe that banks do love houses and like lending to houses as well. It's just the politics behind it that is very important. The other thing I think, that is also very important is that what you can see in many economies, also in New Zealand, is that there are coalitions. That's more like a formal point, or from the literature, that there tends to be coalitions between the governments, banks, and political parties that are well organized. And in some countries, that leads to systems that are very unstable, like in the US, where back in for hundreds of years, the influence of farmers was very important. And the farmers in the US didn't, at some time in the 1700s, they didn't like large corporations. And so they teamed up with populist politicians who also disliked large corporations, including large banks. And so they teamed up together to keep the banking sector very confined to states. And so you have in the US, you have a tradition of state banking, where the banks and the politicians helped or supported by farmers' interests wanted to have their high levels of profits that they can or monopolies that allowed banks to reap rents and become very profitable, which then benefited the local politicians and the farmers as well. So it's very what they call path dependent. Decisions from 100 years ago can affect the way the banking landscape looks now, and that's also true, I think, for New Zealand. Where the banking system is very stable. It's one of the most stable banking systems in the world because the Brits didn't want to have too much interference from the indigenous people and protected the banking system and wanted to be thriving as well without influence from the indigenous people. And so our banking system is very stable, and I think over the last 30 years, if I believe Bernard Hickey, it seems as though the interest of the home ownership or homeowners has become much more important. And so that decisions are in favor of politicians who help homeowners and depositors, and therefore we see that our financial landscape is very much dominated by banks that lend for homes. Which is not abnormal. You see that in Holland as well. The large bank, Rabobank, is a large bank that lends a lot to residential mortgages as well. And so, it's more or less the result of a political outcome.
Yeah, look, there's obviously this sort of, I guess, ingrained love of housing in New Zealand. And we go back to the quarter acre paradise concept from the book in the 1970s, and this big encouragement and push, I guess, for people to become homeowners and the idea that owning your own home is better than renting. And I guess, in some other parts of the world, people are more prepared to rent and the conditions to rent are probably more favourable. But I guess also, you talked about the financial system. Now, I mean, you're obviously an expert in bank capital. So it'd really be interesting if you could explain to us, what is bank capital, why does it matter, and how do bank capital settings encourage banks to lend to housing instead of, say, small businesses or even farms these days?
Yeah, I can help explain that, particularly when it comes to bank capital. Your bank capital is their equity or what the bank's owners put into the bank corporations themselves. And most banks try to minimize the amount of capital. It's because capital is expensive, and therefore it's very important to manage capital very well. And how it works is, if a bank offers you a mortgage, or if somebody gets a mortgage from a bank, then the bank has to put in some of its own money for that. So in classic Basel terms, it's about 8% of own capital that needs to support the mortgage that the bank hands out to you. So that means, whenever a bank starts lending, the investors in the banks have to put up a percentage of the value of the house themselves, which is costly. So, as I said, it's about 8% for for many investments that a bank does, and the rest, the 92%, is funded by depositors or through wholesale or professional parties that invest in banks as well. But that's all debt or liabilities. So the 8% can be costly. If you're the owner of a bank and you have to put up 8% or 8 cents for every dollar, you may think again, like, isn't this a bit pricey? And one thing that is kind of funny about that system is that the 8 cents that you have to put up, or the 8% that a bank has to put up, doesn't discriminate for risk. So, sometimes you have to put up equity, like say $8 for the cents, and that the bank invests in cash. Well, you would think, like, why would I have to invest 8 cents of my own if the bank purchases cash for that or holds cash against that, or very low risk assets like government bonds? So these are almost risk free. And the idea of capital is that it's an insurance for real bad outcomes or for disasters. So when you ask a bank to invest in assets, it prefers to invest in low risk assets just because the risk is low. But then again, there's these capital rules that force banks to hold 8 cents for every dollar invested, which is expensive. And so there are ways, banks and bank regulators have found ways to manage that a bit and offer some relaxation for investments in low risk capital or low risk assets. So whenever a bank invests in cash, you would think like, oh yeah, cash is risk free because what can go wrong with cash? So for cash, there is what they call a risk weight, and the risk weight for cash is 0. So that means that if a bank holds cash, the owners of the bank don't have to invest in any, or don't have to put up any extra money of their own, because it's risk free or deemed to be risk free and has a risk weight of 0%. Now, government bonds are probably on par, especially with OECD countries. They have very low risk, and so there is an incentive for banks to invest in these very low risk assets because they don't have to hold any capital against it, and they don't force the owners of the banks to put up some money for that. So you can see where it goes now. The more riskier it becomes, the more riskier the investments of the bank are, the higher their capital requirements are for that type of risk. So for small and medium-sized firms, in general, I think the risk weight is 100%. That means that for every dollar that a bank invests or lends to a small and medium-sized firm, it has to put up 8 cents, 8 cents per dollar. But when it comes to residential homes, or the homes that we own, the risk weight is very low, so it's about 40 or 30%. So that means that an owner or the owners of the bank or the investors in the bank have to put up only 4 times 8. So it's a very small proportion, about half, say 4 cents for every dollar invested in a home. And so there is an incentive to invest. For banks, the regulations are such that there are incentives to lend to low risk assets. And that is the result of what we call Basel II rules initially, and then they have been superseded by Basel III, but the system is still in place. And it's a way from the regulators to signal to banks that they should not invest in too risky assets. And I think there is a good reason for that. Why would you force a bank to hold capital for something that is totally risk-free? So I can see some cases like, government bonds of, very stable governments. It's risk-free, so why would you force a bank to hold capital against that? For extremely risky adventures like, what is it? There are some asset classes that are extremely risky, and as a result, the reserve or the requirements are higher than 100%. So that means that in some cases, a bank has to hold instead of 8 cents, 16 cents, or in some cases, a dollar for dollar capital investment from the owners for extremely risky assets. So the reason, so in some cases, the risk weight is 1,250%, which is extremely high, which forces a bank to hold as much capital against an asset as the value of the asset itself, and that is to de-incentivize banks from holding too risky assets. So it's a way for the regulator to manage risk at banks. The problem, though, is that these assets are deemed low risk by the regulators, and it incentivizes banks to invest in them. But then, if that investment becomes very large, that creates a risk in itself. So, and that's what we see when 15 years ago with the global financial crisis, banks were so overinvested in safe assets, but didn't realize the risks of these very large proportion or large fragments of assets and how the effects would be later on if a crisis emerged. So what people then, what bankers didn't realize is that, they call it correlations. Many of these assets, if you have an investment in a very large or very large investment in a single asset class, like, homes, what can happen during a crisis that all these home values may go down at the same time, and then you're in trouble because the whole idea about investing, if you invest properly, that's investing 101, you have to spread your investments across various asset classes. Don't hold all your eggs in one basket. Unfortunately, and that's what we see with the banks also in New Zealand, but also in many other countries, is that many banks don't hold their eggs in a single basket. They overinvest in residential mortgages. And that's tricky because, if all these assets start moving downwards at the same pace, in the same speed, then, these value, the value, the lowering values or the loss of value then started affecting the investments of the bank in a big time. And that is what happened during the financial crisis. Many asset classes started moving at the same pace together in the same direction, downwards, very fast, and then you get into a sort of death spiral. So yes, the system is such that it promotes, the system of risk weights is such that it promotes banks to become very safe, but on the other hand, the safety, that safety or the idea of safety can backfire by incentivizing banks to hold too much of a single asset class.
Now, there's also two different key types of lending, I guess, that lenders can do: secured lending and unsecured lending. With secured lending being, I'll give you a mortgage for that house, and your house is my security. So if you can't pay your mortgage, then I can take your house and sell it.
Sure.
And unsecured lending, then I'll loan you this money for a personal loan to go on holiday, but I don't have any security if you can't pay it back. I'm not giving you that loan against any of your assets. So of course, with housing loans, they are secured against the property that they're loaned for. I'm curious as to the is the security of a house better than the security of business assets if I loan to a business, or a farm if I loan to a farmer, for example? I mean, we do get mortgagee sales of farms sometimes, for example. Is that a factor as well in why housing lending is, I guess, deemed more popular for banks?
Yeah, I think so. There's no doubt that the collateral in these cases is it's very steady in value. And so there's almost there's almost zero risk attached to that because of this high quality collateral that is called our home. For businesses, a bit of funny, like, yes, farms, they have land, and manufacturing companies, they may have buildings. But then again, a lot of the value of these companies is not tied to their brick and mortar assets. A lot of value in companies is tied into intellectual property or goodwill and all sorts of intangible asset values. And you can see where it goes to, under this system of risk weightings, is that probably, companies that have very high tangible assets will benefit, whereas those that have high levels of intangible benefits probably don't get their funding. And most of the productive stuff, or most of the productive products of an economy these days are from companies that are high in intangible assets, like the Googles, the Facebooks, and the Apple companies that have high market values, but don't have a lot of tangible assets. So yes, the risk weights are great, and the system of collateral is fine, but it tends to skew the investments of banks into very safe investments, but also investments that are probably not the ones that contribute most to a thriving economy.
So if I'm an entrepreneur and I have a really cool idea in a startup business with a few people, and I really need some capital to invest, how are banks likely to look at me?
Well, the question is, will they look at all? I think more. I spoke with yesterday. I spoke with somebody who advises banks on that and has a wealth of experience on this topic. And he says, if you're not Fletcher or Frontera, good luck. As again, and it's the mirror image of the story that I just told you. Is we are very much focused on lending to residential real estate, our homes. That's all fine. We got no capital gains tax. Everything is geared up to supporting the homeowners, and that is because we vote for that. We want that. We are not explicitly voting for SMEs, and SMEs themselves are fragmented, poorly organized, and so they cannot stand up against powerful politicians, powerful interests of other parties. SMEs, in a way, are the wallflower of our economy, and that's kind of detrimental because a lot of growth and a lot of great ideas will come from that sector. So you, with your startup, you will probably find it very hard to get financing, maybe because of a lack of experience, maybe there's other reasons, but I think predominantly driven by the political economy here that tends to favor home ownership.
You mentioned earlier the Basel or BAL capital standards. Now, these are international capital standards.
Yes.
That the Reserve Bank uses in New Zealand. I mean, they make their own. They make their own sort of subtle changes, I guess, to them, and they're not exactly the same as the versions of the Basel standards used in other countries, but it's all based on the same capital standards. Who makes these capital standards, and how did we get to the situation where we have international capital standards?
Who makes these standards? It's a committee and subcommittees at the Basel, in Basel, Switzerland. They meet and they organize, meetings where people decide about that. There's about 25 countries that decide on these regulations. They have a mandate from, I think, after the financial crisis, it was the G20 that decided to, tell the Basel Committee that they should write rules in such a way that they would never, that the rules were such that at no point there would be a repeat of the global financial crisis. So they operate on, so their mandate is the G20, or the collective of large countries that are part of the G20. And so again, here it's the influence of, the powerful countries that dominate the decision making for Basel, and we then, as New Zealand, which is a non-Basel member, we will copy these rules largely. I think we have some variations. Some of them are, make sense because the Basel rules are extremely complex and they're meant for internationally operating banks, and so they have, there's rules that are so complex that they are not applicable for this country. Fair enough. And in other cases, I think the Reserve Bank has diverged from Basel by making capital standards a bit higher than elsewhere. But again, that's a political decision, I think.
So we've got these international standards. So, as you say, the New Zealand ones vary a bit from some of the other countries around the world. But I guess maybe most other countries aren't as obsessed with housing as New Zealand, but there are, housing is a big issue pretty much everywhere. So have other countries looked at the way that banks are incentivized to lend on housing ahead of other, perhaps more productive parts of the economy, and decided to try and change the system. Has anyone done that? Any major country done that? And if so, what's happened?
Well, that's a good question because and I tried to figure that out, but I don't think there's a clear-cut answer for that because it's the powerful and rich countries, probably a large overlap with OECD countries that are like-for-like comparisons with New Zealand. So there may be countries outside, some idiosyncratic country that goes against the grain, but they are probably not OECD members or Basel members. So, the question then is, can we really use these countries as an example? So I wasn't sure, whether I should go and try to find in the literature review whether there are any countries that diverge from Basel rules or go their own and see if they can stimulate the productive sector. But it seems as though, collectively the world has decided to favor home ownership. So yes, I'm happy to look for examples where there's a contrarian approach to that and whether that's successful, but it doesn't look like that.
So it looks like this is the system we have now.
Yeah.
And as you say, with New Zealand, with our housing obsession, I mean, it's pretty unlikely that either of our two main political parties would shift, or our Reserve Bank would want to shift from this system at the moment. But I guess if we do want to encourage more investment in more productive parts of the economy, we do have a high proportion of SMEs, small and medium-sized businesses in New Zealand. If we want to encourage more growth in there, are there some options you see that would be feasible ones that we could perhaps try and follow to perhaps encourage banks to support them more?
If you really focus only on what banks and bank regulation can do, there are some options. And I think Europe is doing that as well. In European regulations, there is a small and medium-sized firm uplift factor or support factor. And that allows banks to lend to small and medium-sized enterprises with a lower risk weight. And so there's some facilities there, but the European system and in Europe, there's far more initiatives that are there to help SMEs, which I don't think are here. Like, I think there's the European Investment Bank, which tries to support SMEs, and there's a large attention in the European Commission for supporting SMEs as well. And I don't see that here. So yes, we can, or the Reserve Bank may, or at the behest of some rulings or some decisions from government, there may be rules to make life easier for SMEs. But then again, you have to probably change the entire mindset of the entire population and say, well, actually, it's fine that you live in your home with your Apple phone and all the innovative stuff developed in other countries. But, we have to also support our SMEs and, offering a bit of lower risk weights. Yes, it may help. But there's probably far more to do than that to make sure that the productive sector of our economy can thrive or become better or compete more forcefully. So yes, banks can do something, and bank regulations can do some things. And you see that some banks are currently in the current landscape of banks in New Zealand. There are some banks that pay more attention to SMEs. I think Rabo is very much focused on lending to agribusiness. That's fine. I think that BNZ also is, one of the banks that has a high proportion of lending towards SMEs than the other comparable banks. So, but it's all like, these are all small initiatives and step by step, and I think it's going to be a very long journey to make sure that we support these small and medium-sized enterprises.
Yeah, there's another initiative underway that I'm sure you're aware of, this business growth fund that the government is looking at introducing, with banks contributing investment like equity rather than loans. So I guess investing in small businesses. And this is an idea that is already in use in Australia and the UK. So I guess that's interesting. And the Reserve Bank is looking at giving them favourable capital treatment for money they do provide to that fund. So that's an interesting concept. I don't know if you have any particular thoughts on that one.
I think anything helps, and we should have lots of initiatives to promote SME lending. and then figure out which are the ones that are most successful. So maybe the initiative that you just mentioned does work, and with support of the Reserve Bank, it may work. That's all fine, and we can learn from that. And if it's successful, we should be promoting that. Yes.
If we go back to my introduction and I talked about, ANZ 71% of lending to housing and other banks at sort of similar levels, BNZ a bit lower, it does really, we've just had the Reserve Bank's financial stability report out this week, and they do that twice a year, and obviously looking at the financial stability of the sector. It really does come back in New Zealand, though, really to the housing market every time, doesn't it? Because even loans to the rural sector is only, I think, around 10% of bank lending. So the only thing big enough to really cause major trouble to our banks would be housing. It does mean, in a way, all the eggs are in one basket. So as you say, even if the way the capital rules are structured, it does mean lending to housing is safer for banks and the security of the home, etc. It's still that, as you say, if with the GFC example in the US, UK, Spain, places like that, if things do go pear-shaped, they can go very pear-shaped.
Yeah. That's the risk. So it's kind of a false sense of security. It's more like, I'm going to buy a safe car so I can drive faster. But if you then drive faster, you end up in the same position as you were before. So here we have it. Like, the rules are such that they promote safe or riskless lending, but the risks are building up. And that then once in a while leads to, an epic, to a crisis of epic proportions that we have seen 15 years ago. And so it's hard to change that system. I think it is what it is. I think, unlike 15 years ago, what does help is the capital regulations have improved in such a way that there's far more capital to protect the system, and that was, I think, pointed out by Adrian Orr yesterday. Also, the system is safe as such. New Zealand, amongst there's about 4 or 5 countries in this world, or maybe 6 countries in the world, that have had no systemic crisis, and New Zealand is one of them, together with Australia and Canada. So, and then there's some small island states, like I think Malta and Singapore. But if you look at these countries, Canada, Australia, New Zealand, they're pretty safe. Their banking systems are very safe. So yes, the banking system in itself is not a problem. It's more the way that the lending is organized. And again, that's more like a political deal made between voters who want their homes at subsidized homes. In fact, these homes are subsidized because there's almost no risk attached to them. And if something goes wrong, then owners will be bailed out or banks will be bailed out. So that's the world where we live in, which I think is very hard to change. The only thing that I said just is what did change is the capital levels of the banks, and I think New Zealand will be amongst one of the best capitalized banking systems in the world. So there's a bit of trade-off, like the banking system is safe. On the other hand, the big problem still is the very large exposures to a single asset class. And as you pointed out, if something goes wrong in that single asset class, it goes wrong very quickly.
Yeah, absolutely. And I guess at the moment we are in a situation where house prices have been falling, albeit from very, very high levels. But it is obviously, the one big thing in the New Zealand economy we really have to watch closely. So, Martien, we do hear a lot about fintech companies these days, these financial technology companies, digital services, I guess. To what extent could they shift the dial in terms of loans to the productive sector, to small businesses, startups?
I think there's great opportunities for the fintech sector to do that. They're nimble and they're flexible, and they can be very much in tune with the demands from the small and medium-sized enterprises. So, and we know that relationship lending is superior to standard lending and other forms of lending. So, if I were at the Reserve Bank, deciding on this, I would definitely promote that. Although it's all new and in many cases untested territory, there's hopes. And I just looking at the European fintech sector and the Dutch fintech sector, that's been growing massively. And I think one of the reasons is that they're in the same situation, like, housing dominates the entire lending landscape. And there's very little attention from the large, established providers of capital or funding to play in this area. Whereas, there's a huge demand for funding from these SMEs. And then there's the fintechs that can probably and likely can offer a lot of support. So yes, to end this, or to say something on a good note in this podcast, there is hope.
Excellent. Well, look, Martien, I think that's probably a good point to wrap up. That is Martien Lubberink, Associate Professor at Victoria University's School of Accounting and Commercial Law. And I'm Gareth Vaughan from interest.co.nz with another episode of our Of Interest podcast.